A Random Walk Down Wall Street by Burton G. Malkiel. Picture this. It's Holland in the early 1600s. A stunning new flower has just arrived from Turkey, the tulip. Beautiful, rare, and exotic, it quickly becomes the ultimate status symbol for the wealthy. But then something absolutely wild starts to happen. Tulip bulb prices begin to climb, then they soar, and finally, they go completely bonkers. We're talking a single bulb of a rare variety trading for an entire estate. People are selling their homes, their land, their life savings, all for a handful of flower bulbs. And here's the kicker. They're not even buying them to plant. They're buying because they're convinced someone else, some greater fool, will pay even more tomorrow. For one brief, dizzying moment, it seems like the road to infinite riches is literally paved with petals. Everyone from aristocrats to chimney sweeps jumps into the game. Then one day, the spell breaks. Prices start falling. Then they crash. Panic sweeps the nation. Fortunes evaporate overnight. People who were wealthy just yesterday are now clutching worthless bulbs, no different from common onions, wondering what just happened. This story of the tulip bulb craze isn't just a quirky historical footnote. It's the perfect gateway into one of the most important investing books ever written, A Random Walk Down Wall Street by Burton G. Malkiel. First published over 4 decades ago with well over 1.5 million copies sold, this book has become the go-to guide for anyone trying to make sense of the chaotic, often completely irrational world of finance. Burton Malkiel is uniquely qualified to be our guide here. He's not just a brilliant Princeton economist. He's also been a Wall Street insider, serving as a director for a major investment company. He's seen the game from both sides, the ivory tower of academia and the trenches of the financial markets. And what he has to share is remarkably simple yet profoundly powerful. Today I'm going to distill the timeless wisdom of his work. By the end, you'll understand the 2 great theories driving every market, why the so-called experts fail so spectacularly and often, and most importantly, the single most effective, time-tested strategy for building wealth over your lifetime. It's a strategy requiring no genius, no secret information, and no frantic daily trading, just a bit of wisdom and a little discipline. So let's begin our walk. Every person who's ever thought about investing faces one fundamental question: how are prices actually determined? When you buy a share of a company, what are you truly buying and what's it worth? Throughout history, Malkiel explains, investors have been torn between 2 competing ideas. He calls them the firm foundation theory and the castle in the air theory. Understanding these 2 is the key to understanding everything about markets. The firm foundation theory sounds most logical. It argues that every investment has an intrinsic or true value based on solid facts, things like a company's assets, earnings, and growth potential. A believer in this theory, a quote, fundamental analyst, acts like a detective, studying financial health, analyzing the industry, and projecting future profits to determine what a stock should be worth. If the market price is below this firm foundation, it's a buy. Above it, it's a sell. Eventually, the market will come to its senses, and prices will correct. It's disciplined, logical, and rather sensible. But then there's the other theory, the castle in the air theory. This one isn't about logic, it's about psychology. The famous economist John Maynard Keynes was one of its greatest champions. He believed the average investor wasn't interested in painstakingly calculating true value. They wanted to figure out what everyone else would be willing to pay tomorrow. The game, Keynes said, isn't picking the investment you think is best, but picking what you think other people will think is best. He compared it to a newspaper beauty contest, where you don't pick the face you find most beautiful, but the face you think most other people will vote for. The winner is whoever best anticipates the psychology of the crowd. In this view, an investment is only worth what someone else will pay for it. Its value isn't anchored to earnings. It's held up by the hopes and dreams of the masses, a beautiful, shimmering castle built in the air. As long as you can find someone to buy it from you at a higher price, what you paid doesn't matter. This is also known, less charitably, as the greater fool theory. It's perfectly fine to be a fool and pay an inflated price, as long as you can find a greater fool to sell to later. This brings us back to those tulip bulbs. That was a world of pure castles in the air. There was no firm foundation justifying a tulip bulb being worth more than a house. There was only collective belief that prices would keep rising forever. And this madness isn't ancient history. Malkiel walks us through one speculative bubble after another, showing how this same human drama plays out repeatedly. Take the South Sea bubble in 18th century England, a company formed with a monopoly on trade to the South Seas. The public became convinced this trade would bring unimaginable riches. Stock prices soared. The excitement was so infectious that absurd new companies popped up everywhere. One promoter famously offered shares in a company for carrying on an undertaking of great advantage, but nobody to know what it is. The prospectus promised unheard-of rewards. People lined up to throw money at him. He took their cash and promptly disappeared, never to be heard from again. The South Sea bubble, like the tulip craze, eventually collapsed in panic, wiping out fortunes and leading Sir Isaac Newton, who himself lost a fortune, to lament, "I can calculate the motions of heavenly bodies, but not the madness of people." And lest we think this only happened to people in powdered wigs, Malkiel brings us closer to home. The Roaring Twenties in America turned the stock market into a national pastime. Everyone was sure they were on a one-way street to riches. Stories of manipulation were rampant, with groups of traders forming, quote, pools to artificially drive up prices, plant exciting rumors, and then dump shares on an unsuspecting public just as excitement peaked. It all crashed in 1929, leading to the Great Depression. The headline in Variety summed it up perfectly: Wall Street lays an egg. Even in our modern era, with computers and instant information, we're no more immune. Malkiel points to the soaring 60s when growth was the magic word. Any company with tronics in its name, whether making electronics or shoelaces, saw stock prices skyrocket. This was followed by the Nifty 50 craze of the early 1970s, where even professional investors decided a handful of big blue-chip stocks like IBM and Xerox were so good you could buy them at any price and never sell. For a while, they were right. Until they weren't. Many of those stocks crashed, losing over 80% of their value. And, of course, there was the great internet bubble of the late 1990s, perhaps the biggest castle in the air of all time. Companies with no profits, no clear business plan, and sometimes no revenue at all, were being valued at billions simply because they had .com at the end of their name. Old valuation rules were thrown out. Analysts invented new metrics, like eyeballs, how many people visited a website, to justify astronomical prices. It was a time of irrational exuberance. A company called theglobe.com, an online message board started by two college students in their dorm room, went public with almost no revenue. Its stock price soared 1,000% on the first day. The founders, barely out of their teens, became paper multimillionaires overnight. But as with every bubble in history, the party ended. Over $8 trillion of market value evaporated when the dot-com bubble burst. As if the entire economic output of Germany, France, England, and Japan simply vanished. So if markets are prone to these wild swings of euphoria and despair, if they're so often driven by crowd psychology, how is anyone supposed to invest successfully? This leads us to the two main toolkits professionals use to navigate the market: technical analysis and fundamental analysis. Technical analysis is the art of the castle-in-the-air theorist. A technician or chartist doesn't care what a company does. They don't care about earnings or products. They believe all that information is already reflected in the stock's price. All they study are charts of past price movements and trading volumes. looking for patterns, head and shoulders, double bottoms, resistance levels, believing history repeats itself, and these patterns signal where price is headed next. They believe the market is 10% logic and 90% psychology, and they're trying to read the market's mind. The fundamental analyst, on the other hand, is a firm foundation believer. They believe the market is 90% logic and only 10% psychology. They do detective work, poring over financial statements, analyzing competitive position, and forecasting future earnings to arrive at a stock's true intrinsic value. So who's right? The chartist trying to predict crowd whims, or the fundamental analyst trying to calculate true worth? This is where Malkiel introduces the big disruptive idea that shook Wall Street's foundations, the random walk theory. Taken to its logical extreme, the theory says short-term stock market movements are completely unpredictable. The next move is no more predictable than a coin flip. Past price movements, those patterns beloved by chartists, contain no useful information about the future. This sounds like nonsense, right? We can all look at a stock chart and see clear trends, clear patterns. But Malkiel asks us to consider a simple experiment. Imagine creating a stock chart not from real market data, but from flipping a coin 100 times. Heads, the stock goes up half a point. Tails, it goes down half a point. When you plot the results, the chart looks astonishingly like a real stock chart. You'll see uptrends, downtrends, and even patterns that look like head and shoulders. A chartist friend of Malkiel's, when shown one of these randomly generated charts, got incredibly excited, demanding to know the company so he could buy immediately. He wasn't amused to learn it came from a coin flip. The point is, our brains are pattern recognition machines. We see patterns everywhere, even in random noise. The trends we see in markets are often just statistical illusions, no more meaningful than a gambler's lucky streak at the roulette table. This is what economists mean when they say stock prices follow a random walk. The market has no memory. Today's price change is independent of yesterday's. If this is true, then all the work of technical analysts, all their elaborate charts and theories, is useless. And decades of rigorous academic studies have tested this. They've tested all the popular technical trading rules, filter systems, Dow theory, relative strength systems. The conclusion is overwhelmingly clear. Once you account for trading costs, none of these technical strategies can consistently beat a simple strategy of just buying and holding a diversified portfolio of stocks. Technical analysis is, as one academic put it, akin to astrology and every bit as scientific. Alright, so the chartists might be wrong, but what about the fundamental analysts? The smart detectives who do the real work? Surely their careful analysis of a company's value must give them an edge. Here the evidence is even more shocking. First, the core of their job is forecasting future earnings. But this turns out to be incredibly difficult, if not impossible. The world is full of random, unpredictable events, new inventions, political crises, management changes, global pandemics. These things, by their very nature, cannot be forecasted. Second, companies can use creative accounting to make earnings look better than they really are. Malkiel describes a firm's income statement as being like a bikini. What it reveals is interesting, but what it conceals is vital. The scandals at companies like Enron and WorldCom showed just how deceptive reported earnings can be. And finally, there's the biggest problem of all. The market is just too efficient. There are tens of thousands of smart, highly paid, full-time professionals, all looking for that same undervalued stock. As soon as any piece of public information becomes available, an earnings report, a news announcement, it's almost instantly absorbed and reflected in the stock's price. By the time you read about it in the newspaper or hear an analyst's recommendation, it's almost certainly too late. The opportunity is gone. This is the essence of the efficient market hypothesis. It doesn't mean prices are always right. They're often wrong. What it means is it's impossible for anyone to consistently know when they're wrong. The market is so quick to react to information that it's like a perfectly balanced scale. All available information is already priced in. If this is true, then trying to find undervalued stocks is like trying to find a $100 bill on a crowded sidewalk in the heart of the financial district. If it were really there, someone would have already picked it up. The ultimate test of this idea is looking at the performance of the professionals themselves, the managers of mutual funds. These are the best and brightest with all the resources in the world at their disposal. And yet, study after study, decade after decade, shows the same sobering result. The average actively managed mutual fund fails to beat the market. In fact, over long periods, the vast majority, 2/3, 3/4, sometimes even more, underperform a simple unmanaged market index. Why? Two simple things: fees and trading costs. Active managers charge high fees for their supposed expertise. Their constant buying and selling racks up transaction costs. An index, on the other hand, has no manager to pay and does very little trading. So even before you start, the active manager is running a race with weights tied to their ankles. So if neither the chart watchers nor the value detectives can consistently beat the market, what is an investor to do? This leads us to the new way of thinking that came out of academia, what Malkiel calls the new investment technology. The first big idea is a new way to think about risk. We all know that to get a higher return, you have to take on more risk. But what is risk? For a long time, people thought of a stock's risk as its total volatility, how much its price jumps around. But a Nobel Prize-winning idea called modern portfolio theory showed that this was the wrong way to look at it. The theory's brilliant insight is that you can combine risky investments in a portfolio, and the portfolio as a whole can actually be less risky than the individual components. Malkiel explains this with a beautiful, simple story. Imagine an island economy with only two businesses, a seaside resort and an umbrella manufacturer. When the weather is sunny, the resort does great business, but the umbrella maker does poorly. When it's rainy, the resort is empty, but the umbrella business is booming. Each business, on its own, is very risky. Your profits depend entirely on unpredictable weather. But what if you diversified? What if you put half your money in the resort and half in the umbrella company? Now, when it's sunny, your big gains from the resort are partially offset by losses from the umbrella company. And when it rains, your big gains from the umbrella company are offset by losses from the resort. By combining these two perfectly negatively correlated businesses, you've created a portfolio that makes steady, predictable profit no matter the weather. You've used diversification to essentially eliminate risk. Of course, in the real world, it's not this perfect. Most companies tend to move up and down together with the broader economy, but as long as they don't move in perfect lockstep, diversification will always reduce your risk. This is the closest thing to a free lunch in finance. And the benefits are even greater if you diversify internationally, because different countries' economies don't always move in sync. This insight separates risk into two types. There's the unique risk of a single company, a new product succeeding or failing, a factory burning down. This is called unsystematic risk, and it can be almost completely eliminated through diversification. If you owned 50 different stocks, one company's bad news will likely be balanced out by another's good news. But there's another kind of risk you can't diversify away. This is the risk of the entire market moving up or down due to big economic events, like recessions or interest rate changes. This is called systematic risk, or market risk, and this, the theory says, is the only kind of risk you get rewarded for taking. This led to the famous capital asset pricing model and the concept of beta. Beta is simply a measure of a stock's systematic risk, how sensitive it is to overall market movements. The market as a whole has a beta of 1. A stock with a beta of 2 is expected to be twice as volatile as the market. A stock with a beta of 0.5 is expected to be half as volatile. The theory said that if you wanted a higher return, all you had to do was build a portfolio with a higher beta. For a while, beta was all the rage on Wall Street. But, as Malkiel explains in later editions, it turns out even this elegant theory doesn't perfectly match reality. Studies have shown that the relationship between beta and return isn't as strong as the theory predicted. Sometimes high beta stocks don't deliver higher returns, and sometimes low beta stocks do surprisingly well. This has led to a new field called behavioral finance, which brings us full circle, back to the idea that investors aren't always rational. It combines psychology and economics to understand the systematic mistakes we all tend to make. We're prone to overconfidence, believing we're better than average drivers and better than average investors, which leads us to trade too much. We suffer from loss aversion, which means the pain of losing $1 is more than twice as powerful as the pleasure of gaining one. This makes us hold on to losing stocks too long, hoping they'll come back, while we're too quick to sell our winners. We engage in herd behavior, buying what's popular and selling in a panic, which is why we so often buy high and sell low. Understanding these biases is crucial, not because they can help you beat the market, but because they can help you avoid beating yourself. So after this long walk through manias, theories, and human psychology, what's the final practical advice? What's the single best strategy for the average investor? Malkiel calls it the no-brainer step. And it's the culmination of all the evidence he's presented. If the market is highly efficient, and if even professionals can't consistently beat it, and if our own psychology works against us, then the most logical thing to do is stop trying to beat the market. Instead, you should simply aim to be the market. How do you do that? You buy a broad-based, low-cost index fund. An index fund is a mutual fund that doesn't have a star manager trying to pick winning stocks. It simply buys and holds all the stocks in a particular market index, like the S&P 500 or, even better, a total stock market index that includes thousands of companies, large and small. By doing this, you're guaranteed to earn the market's return. You'll beat the vast majority of professional investors year after year. Your costs will be incredibly low, often less than 1/20th of what an active fund charges. And because the fund does very little trading, it's extremely tax efficient. This is the core of Malkiel's advice. But he doesn't stop there. He provides a complete, practical guide for investors at every stage of life. He calls it a life cycle guide to investing. The key idea is that your ability to take risk depends on your age. If you're in your 20s, you have decades of earning potential ahead. You can afford more risk because you have plenty of time to recover from market downturns. So your portfolio should be heavily weighted towards stocks, including international stocks and those from fast-growing emerging markets. As you move into your 30s and 40s, and then your 50s, you gradually dial back the risk. You start shifting more of your portfolio from stocks into safer assets like bonds. Bonds won't give you the high growth of stocks, but they provide a steady income stream and are less volatile. By the time you reach retirement, in your 60s and beyond, your portfolio should be much more conservative, designed to preserve capital and provide reliable income to live on. But even then, Malkiel advises keeping a healthy allocation to stocks to provide growth and protect your purchasing power against inflation. He also champions two simple, powerful techniques for anyone saving regularly. The first is dollar-cost averaging. This just means investing a fixed amount at regular intervals, say $100 every month. When the market is high, your $100 buys fewer shares. When the market is low, your $100 buys more shares. Over time, this automatically ensures you buy more shares at low prices than at high prices, reducing the risk of putting all your money in at a market top. For anyone saving through a 401k plan, you're already doing this. The second is rebalancing. Let's say you decide on a mix of 60% stocks and 40% bonds. After a great year for stocks, your portfolio might have drifted to 70% stocks and 30% bonds. Rebalancing simply means selling some stocks and buying some bonds to get back to your original 60/40 mix. It's a disciplined way to force yourself to sell high and buy low, trimming your winners and adding to the asset class that has underperformed. For those who enjoy the thrill of the game and want to try picking their own stocks, Malkiel offers a few simple rules, what he calls the do-it-yourself step. But he makes it clear this should be done with your fun money, not your serious retirement savings. The core of your portfolio, he insists, should always be indexed. The journey through a random walk down Wall Street is a liberating one. It sweeps away the noise, the complexity, and the intimidating jargon of the financial world. It tells you that you don't need to be a genius. You don't need to follow breathless predictions on financial news channels. You don't need to find the next hot stock. Success in investing, Malkiel teaches us, is not about making brilliant moves. It's about consistently avoiding stupid ones. It's about understanding the big picture, staying disciplined, keeping your costs to a bare minimum, and letting the power of the market and the miracle of compound interest do the heavy lifting for you. It is, in the end, a get-rich-slowly but surely book, and that is the wisest way of all. As we come to the end of our walk, it's worth pausing to reflect on why this book has remained a classic for nearly half a century. In a world constantly changing, with new financial products, new technologies, and new gurus popping up every day, Burton Malkiel's core message has remained steadfast, and, if anything, has become even more relevant. The true genius of A Random Walk Down Wall Street is that it's not really a book about finance, it's a book about wisdom. It's about human nature, about our tendencies toward greed and fear, our overconfidence, and our desire to find patterns in a world that is often random. The stock market is simply the arena where these human dramas play out on a massive scale. What Malkiel does so masterfully is cut through all that drama with the clear, simple light of evidence. He shows us again and again that the most successful path is often the most boring one. It's the path of humility, of acknowledging that you probably don't know more than the collective wisdom of millions of other investors. It's the path of discipline, of sticking to a plan, even when every emotional instinct is telling you to panic or chase a fleeting trend. The most powerful lesson, I believe, is about control. We live in a culture that tells us we need to be in control, to be proactive, to make things happen. But in investing, trying to exert too much control by constantly trading, timing the market, or searching for the next big thing is precisely what leads to failure. Malkiel's philosophy is a kind of financial zen. It teaches us the power of letting go, of accepting the market's return, of trusting the process of long-term compounding, and of focusing on the very few things we can control: how much we save, how much we pay in fees, and how we allocate our assets. So how can you put these profound lessons into practice? Starting today, it's remarkably simple. First, and most importantly, start saving. Now. It doesn't matter if it's a small amount. The single greatest force in your financial life is not a hot stock tip. It's the miracle of compound interest. Time is your greatest ally, and the sooner you put it to work, the more powerful it will be. Second, open a tax-advantaged retirement account, like an IRA or a 401k if your employer offers one. This is your first and best tool for dodging the tax collector legally. And third, within that account, buy a low-cost, broad-based index fund. A total stock market index fund is a perfect place to start. This one simple step allows you to own a piece of thousands of companies, achieve broad diversification instantly, and all but guarantee that you'll outperform the majority of professional investors over your lifetime. That's it. That's the secret. It's not glamorous. It won't make for exciting conversation at a party, but it is the time-tested, evidence-backed path to financial security. That was a summary of A Random Walk Down Wall Street by Burton Malkiel. We've explored the main ideas today, but I'll be honest with you. A summary is just a map. It can't replace the journey itself. The real magic happens when you read the book. It's in the quiet moments, when a particular story or a simple phrase connects with you in a way you didn't expect. This summary is here to help you decide if this book deserves your time. If anything we've talked about has struck a chord, I encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change the way you see the world of money and your place in it. You can find a link to the book in the description below. Also, if you found this summary valuable, please take a moment to like this video and subscribe to the channel. It lets us know we're on the right track and ensures you won't miss our next exploration into another life-changing book. Let's keep learning and growing together.